Hi there, my name's Kane Hooper. I'm the owner of Cloud Accounting Partners, an online bookkeeping and accounting firm. And today I want to talk to you about what is the best legal structure for your small business. Now, whether you're looking at a startup or an existing small business, I want to delve into this topic. It's one of the questions I get most is what is the best structure to set up my business? Because it can have real big impacts on the way you distribute profits, the amount of tax you have to pay, and it's got quite a number of other legal ramifications that, if not done correctly, can open you up to quite a number of risks. So I'm going to go through the different structures. This is going to be a brief overview of each of them, not to go into too much detail, but to give you enough of an understanding to start with so you can start thinking about, is my current structure getting me the best benefit with the least risk? Do I need to change? Or if I'm starting up, what's the best way to start? Now, disclaimer, have to read this out. This presentation contains legal, accounting, and technical information that can materially impact your profits and taxes. I'm providing this information as education to assist you in understanding business structures. You should always seek professional advice before structuring your business. And that's the key here, is that what I'm providing now is to give you some education. Please get professional advice if you are looking at setting up or changing a structure. So there's 4 structures I'm going to look at today. The sole trader, that's just the individual operating as himself. The partnership, 2 or more people working together. The company structure, and trusts. I'm going to start with the sole trader. So the sole trader is the individual person, in legal terms known as a natural person, which becomes important later on. And they're the person who runs their own business, retains all the profits, and suffers all the losses. And the individual and the business are not separate legal entities. The owner and the business are synonymous. So as a sole trader, you and the business are considered one and the same. Any profits, they're yours. Any losses, they're yours. There is no distinguishment between each of the entities. When you do a tax return, you just do a single tax return as a sole trader, and that covers all the income that came through the business, all the expenses, whatever profit was left, and so on. So here's how it works in terms of profits and taxes. So let's just say you've got your small business, you're the sole trader, and you've made an $80,000 profit for the year. And when that profit at the end of the tax year is accounted for, it's considered your income. And you are taxed at, I think this would end up being about 37 cents in the dollar tax rate, and you pay about $16,500 in taxes on that particular profit. It's no different from taking an $80,000 wage. The taxes are exactly the same. Now, the one thing that's quite important to note about being a sole trader is you have unlimited liability. What that means is whatever debts you incur, you as a sole trader are 100% liable for those debts. So let's take this situation here. Company's got $20,000 in cash, $40,000 in debt. Can't pay all its debt, runs into big trouble. Now what can happen is, let's just say that debt's owed to the bank. You've got a property. The bank will come after your personal property, put it up for sale, and discharge the debt. You therefore have the potentiality of losing your personal assets as a sole trader if you fail to manage the business correctly. So there's some advantages and disadvantages to being a sole trader. Number one, it's really easy to set up. You set up a sole trader, or set up a company, or business as a sole trader by registering a business name, getting an Australian business number, and off you go. Cheap to set up. It costs practically nothing. Very simple tax reporting. You just do your one tax return at the end of the year, which covers the business and your personal tax. And you, as a sole trader, have total control of the business. The disadvantages, and the big one for me, is the unlimited liability. You have no protection. You take all the risk. And potentially, you may lack the expertise to handle all parts of the business. So as a sole trader, if you're the sole owner, sole operator, you may be excellent at your trade, excellent at your craft, better than everyone else, but maybe lack in other areas such as the management side or the handling of personnel. The second structure is the partnership. And the partnership is a business being carried out by persons together with a view to making a profit. And similar to the sole trader, the partners and the business are not separate legal entities. The partners and the business are synonymous. Now, there's a lot more legal information regarding partnerships. It can get quite complicated. Not going to get into it at all. I'm just going to cover the simplicity of a partnership. But if you consider going into a partnership, you better get good advice, because there's all sorts of contract law and who's liable for certain things and so on and so on. Now, in terms of the handling and profits and the taxes, it's very similar to a sole trader, except the profits are split between the partners. It may not be 50-50, just depends on how you've set up the partnership. So, profit, let's say each individual gets $80,000 each, and it's just taxed in the exact same way that you would if you were earning an $80,000 wage. You're going to pay $16,500 in taxes. Similar to a sole trader, the partnership usually has unlimited liability. There is a form where you can limit liability for certain people. I'm not going to cover that now. That's getting into a little bit more complicated. So similar, if you've got debt and you can't pay it, the partners are personally liable for it. The difference is here, under a partnership, say the bank's going to sue. Now, you've got partner A and partner B. Partner A has no assets, nothing. Partner B has a house. The bank's going to go after partner A. They can go after either or both. It's just based on their decision. And in the same way, in order to discharge the debt, the bank will sell the property, partner B loses his asset. So there's a risk in the partnership, is that if you have a large amount of assets and your other partner has nothing, you are likely to take all of the risk and all of the issues in case the partnership runs into trouble. In terms of advantages, again, cheap to set up, though you may want to put together a partnership agreement, which you may want lawyers involved in. Simple tax reporting, very similar to a sole trader. And you can complement the missing expertise. So you might go on a partnership with someone who's excellent at the trade, you're good at management, great, works well. Disadvantages, and my big sticking point, is unlimited liability. One or both of the partners take all the risk, depending on who has the majority of assets. And it is legally complicated. There's a whole partnership act, which I had to study as part of my MBA. And while it's simple in itself, there's just a lot to know and understand. The company. Okay, the company is, from my point of view, one of the most important structures. And this is why a company is regarded by the law as a separate legal entity, which is a separate artificial person. It's considered legally as its own individual person. Now, as a legal entity, it's separate from the owners. And it can do all things a natural person can do. It can sue or be sued, it can buy property, it can enter into contracts, and so on. But the key here is the separation of the owners and the business itself. In terms of a company structure, you have shareholders. They're the owners. They're the people who usually invest or put the money into the business, and they also get the benefits of the profits of the business. The directors are individuals who are put in place by the shareholders to manage the business on behalf of the shareholders. So for something like a BHP, where there's hundreds of thousands of shareholders probably, in order to represent all those shareholders, they appoint directors who are responsible to the shareholders to make sure that the business is making money, it's profitable, and the shareholders are getting returns. Then, of course, you've got the managers and the employees of the company itself that are involved in the day-to-day operation. Now, the interesting thing from a small business perspective, and while these three areas or three parts of the structure are quite separate, have their own purposes, benefits, risks, and so on, one individual can be all three. So I can own a business and I can be the sole shareholder, the sole director, the sole manager, the sole employee. I can be all of it. So I'm wearing, in that case, multiple hats. So in terms of the operation, it's very similar to being a sole trader, except there's a number of benefits from a company structure. Number one is a company is considered to have what is known as a corporate veil. So when a company is created, it creates a veil. So here we go here. So you've got the company on the left, say the directors and the owners on the right. But by creating a company, there's this veil or this blind to shield the owners and directors from external accountability. So long as the directors abide by their duties, they can operate without external interference. That's in most cases. There's a few laws on that. But generally speaking, so long as the director remains legal, and I'm going to cover in another video director's duties because it's quite important, then there's a veil, a separation from you and the company. So you no longer become accountable to external bodies such as banks or people you owe money to, or lawyers if they're suing the company. And here is the major benefit of a company. So what it's got is it's known as having limited liability. And what that means is that the liability of the shareholders is limited to the amount they have invested in the company. So as a shareholder, you start a business and let's say you invest $10,000 into the business. And you're trading for a couple of years and you get to this situation where you've only got $20,000 cash and $40,000 debt. You're going to lose, if the business shuts down, you're going to lose the $10,000 you invested. That's just part and parcel of it. However, there's a veil between you and the company. Again, so long as you've done nothing illegal, then the banks, the creditors, the lawyers, etc. cannot come after you personally. Your personal assets are protected. Now, it may be that the company closes. Okay, fine, you lost your $10,000 investment, but you're not liable for any other of the debts that the business incurred, again, so long as you've been operating in a legal manner, which I will cover in another video at some time. But that's the limited liability aspect, and that protects the shareholders, and the directors are also protected from liability. Now, in terms of profits and taxation, the company, say it makes $180,000 profit, the company as a legal entity has to pay its own tax, and that is set at a straight 30%. So in this case, the company would pay $60,000 in tax. Now, it may decide to distribute some or all of the remaining profits, which is $120,000, to the shareholders. That is at the discretion of the directors. So directors may say, no, this year we're not going to distribute any of the profits or the profits to the shareholders. We're going to reinvest it in the company. Or they might decide to distribute all of the profits. Now, as a small business, if you are the shareholder, the director, and the manager, well, you can just decide, I want all of the profit. Or you might decide to keep some of the money in the business, only pay 30% tax, and use that money to grow the business for future increased profits. But that's the benefit here, is you can now decide what you want to do with the profits and minimally cap it at 30%. So if there's a distribution, and let's just say they decide to pay a $60,000 dividend to the shareholders, that's then distributed evenly amongst the shareholders based on the number of shares they own. And then those individuals may pay a little bit more tax on that income. The 30% tax that's already paid does not need to be paid again. But if your tax rate is at, say, 37%, then you'll pay an extra 7% on the money distributed to you. There's a little bit of complication around that, and we can get into that at another point. So company advantages. For me, the biggest advantage, limited liability. Love it. Protects you as a shareholder and potentially as the director. You've got the corporate veil. You're limited to external accountability. The company itself can be sued. The company itself can be liquidated. But you as a director and shareholder are protected if you've acted in a legal manner. And it's very easy to transfer ownership. You can sell shares quite easily. Now, disadvantages, it does cost more to set up. Though, I think it's around about, off the top of my head, $600 to set up a company these days. Something like that. I forget the exact figure. There's more costs in terms of taxes, because you've got to do a tax return for the company and you've got to do your own personal tax return. Accountants will tend to charge more for a business tax return. So, maybe it's $2,000 as opposed to the $200 you personally spent. So you might say it's approximately $3,000 more to run a company than to be a sole trader. Personally, unless I'm only making $60,000 a year, I would definitely be interested in the company structure regardless of those costs. Plus, those costs are tax deductible, so it's not as bad as it looks. The other disadvantage with companies is companies are under the Corporations Act. Directors have certain directors' duties that they must abide by, and it can be quite complicated to learn all of those duties, and you leave yourself open to risk if you do not understand those duties as a director. But I will cover that at some point. But for me, the advantages definitely outweigh the disadvantages. The last structure, which I'm not getting into much at all because it deserves its own video, is the trust structure. And a trust is a structure whereby the legal owner of the trust manages the assets for the benefit of the particular individuals. So a mother and a father might set up a trust for their children and ask the accountant, which I wouldn't necessarily recommend, to manage the trust for a certain number of years and then to distribute the profits when, say, a property sells at some point for the benefit of the children. And that was generally why a trust was set up in the first place. Now, the structure of a trust. First, you have what's called the settlor. And this is the individual who sets up the trust. So it might be the husband, the wife, or those who are setting it up for the children. There's certain regulations about who can or can't be the settlor of the trust. But these are the guys who set it up and who choose who is going to manage the trust. The who is known as the trustee. They manage the trust and are legally responsible and legally liable for the trust and any debts that it may incur. The beauty of it, though, is the trustee can be a company. And there we get the benefit of limited liability. So the settlor appoints a trustee. Could be an individual, could be a company. Then we have the trust, which holds the assets. And the assets could be property. It could be profit from a company. It could just be cash. It could be any sort of asset. From the point of view of a business, we're looking at looking after the profits and distributing those profits to individuals. Then you have what are called the beneficiaries, those who benefit from the trust. So it might be the husband, the wife, the children, could be any number of people. But from a company point of view, if you've got a small business, it's likely to be you and your spouse, your husband or your wife, as the beneficiaries. Now, very briefly on this, there's quite a number of benefits from operating a trust structure in the way you distribute your profit. So say, similar to the sole trader, you had an $80,000 profit. Now, with the trust, you or the trustee can decide how that profit is going to be split. And he's going to keep it simple. In this case, we're going to give $40,000 to the husband and we're going to give $40,000 to the wife. They then get taxed as normal individuals, and under the tax rate, in this case, I worked it out as $3,769 each. So what's that? It's about $7,500 in tax in total. Here's the beauty. If it was just a sole trader where one person earned the $80,000, you would have paid $16,500 in tax. So by having a trust structure, by being able to choose where the profits are distributed to, there's an $8,900 difference in the amount of tax you pay. And this is the beauty and benefit of a trust structure. Now, it doesn't really work if you're running the business and your husband or wife is working and making $100,000 a year. It doesn't really have much benefit. It really only works if a husband and a wife are working in a business together, or one's working, the other's looking after the kids. Then you can distribute the profits and really legally reduce your tax. So you really need to get advice on a trust structure. They have to be set up right. There's different types of trust structures. This one is known as a discretionary trust because the trustee has the discretion on how the profits are going to be distributed. There's also risks if you don't distribute the profits and they stay within the trust. It's taxed at the highest tax rate, which is about 49%, something like that. So you need to do it right. So you need to make sure you get really good advice in that area. Right, so I would like to know what you want to hear next in business. Anything from an accounting point of view, business structure point of view. I've run quite a number of businesses. So if you want to know about sales, marketing, how to handle employees, anything, put it in comments. I'd really like to hear about it. My firm's Cloud Accounting Partners, and I offer online bookkeeping and accounting services. I get your accounting and bookkeeping into the cloud. We handle all your bookkeeping and all your accounting. You get real quick financial reports. You can get your profit and loss whenever you need it. Your financial records are kept on a 3-day or up to date on a 3-day rotating basis. You get away from paper. And for you as an owner, it drastically frees up your time. I mean, I've saved owners. One client I saved them 20 hours a month just by setting them up. It was brilliant. And the further we go along, there's more time-saving benefits. If you go to the website, you can see the price, you can get information. All the information you need is there. It's got my personal mobile, my email. You can ask any question, happy to give you the data so that you can make a decision. I've got a new service which I've just started, which is a virtual CFO. So CFO is the Chief Financial Officer, and they're responsible for the financial state of the organisation, how well it's doing financially. Is it increasing in its wealth and its profits? And pretty much every corporation has a CFO, but not many small businesses do. And the beauty of the virtual CFO program is, as a small business, it's very affordable for you to get the corporate expertise in your small business. You can do forecasting and cash flow, help you manage your cash flow, provide very detailed management reports, enhance your internal controls, develop strategic plans. That's only some of what I can do as a virtual CFO. Just as my experience, I've run 8 businesses. I'm an MBA graduate, graduated top of my class. I've been involved in company turnarounds. I've taken businesses from $2 million turnover to $12 million in 12 months. I know how to be a CFO. I know how to grow businesses, and your return on investment would be quite substantial in this service. I'm excited about the virtual CFO service. I'm really looking forward to getting involved in it. Anyhow, it wasn't intended as a sales pitch, but if you want more information, the virtual CFO program is new. You'd need to contact me personally. I haven't priced it yet, but there will be a level for every business. So regardless of your size, it will be affordable and you will be able to maintain the payments without a problem. So thanks so much, guys. It was a pleasure talking to you today. I love this stuff. It gets me really excited, and I'm looking forward to answering any other questions you may have.